The Commonwealth Bank reduces its apartment exposure. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this article from the Financial Review discussing the CBA's shrinking apartment loan books, or, well, their reduction of risk. That's really the business banks are in. It's all about managing their risk. So let's jump over to the Property Council data room. Let's just have a look at the median residential unit values at the moment. You can see here Sydney, they're sitting at 700,000. The weighted average is at 575. Then you have Melbourne, 575. Canberra, 440. Hobart at 405. Brisbane at 390. Perth, 370. Adelaide, 339. Darwin at 295. And this is from the 30th of April. And if we bring some newer data here, we can see just the core, well, from CoreLogic, the delta change in dwelling values over the last 12 months. Regional WA has taken the biggest hit of all of them, where most are still slightly in the positive, but that's because it took a big hit. It took a big hit. So let's jump back here and have a look at this article. Before I get into it, let's take a shot of coffee, everyone. The only way to start the day. So, Commonwealth Bank has slashed lending on apartments by almost 2/3 and halved the value of apartment loans as a proportion of its residential lending book in the past 3 years, the bank's latest full-year results show. Now, isn't that interesting? Isn't that interesting? We've all heard the stories of certain suburbs where banks won't lend into. It even goes down to the buildings sometimes. They'll only expose themselves a certain amount, so a certain number of apartments in a building. It'll get to that level, or a postcode. Because they really are in the business of managing risk. They're in the business of managing risk. They're not in the business of being your friends. Don't believe the commercials, guys. Don't believe them. Sorry. The bank's lending on apartment developments fell from 4.5 billion, 36% of its 12.3 billion residential loan book in the year to June 2017, to 1.6 billion, just 18% of its total 8.8 billion in the 2020 financial year, revealed last week. Well, I mean, look at this year, June 2017. I'll bring up this chart here, which is showing foreign investment. Have a look there. It was just on the downward end of the construction boom, building approval boom that was, well, over 90% from foreign investors. Loan repayment deferrals to borrowers facing financial hardship under the pandemic cut the value of impaired home loans over the 6 months to June, but effects of the pandemic were already being felt on new developments, albeit on a limited scale, the bank said in its earnings presentation to investors. Project-specific issues, including those arising from COVID-19 restrictions and economic impacts, low valuation, uncertain employment status, has at this point resulted in pre-sale settlements taking longer and delaying full repayment on only a small number of projects, it said. The near 2/3 cut in lending on apartments since 2017 by Australia's largest mortgage lender shows why the country's pipeline of apartment and denser dwellings is narrowing. A dynamic worsened by the pandemic that has all but stopped the inbound migration of foreign students and workers who provide much of the demand for new housing stock. There's going to be, well, this is the thing. People are concerned about a decline in the pipeline, in the supply, and they're saying, oh, that'll drive up prices. But do they seem to be taking into account the fact that migration is pretty much non-existent right now and international students have completely stopped? The hope is that those will magically turn on next year, in January. So let's say we do. Let's say we open the borders and it magically, we magically allow people to come here. But will they come to Australia? I think a lot of that has to do with the perception of Australia, how we've handled this illness. We'll have to see, everyone. We'll have to see. I wouldn't bet on it. I wouldn't bet on it miraculously turning back on, particularly with the US dollar weakening. It means you're going to get, well, your money's going to go further in United States education institutions. And sure, they have a lot of social issues over there, but the brand name associated with the US university is on a different level to an Australian one. Banks are continuing to lend to some developers notwithstanding the coronavirus pandemic, but they're being selective. said Ashurst partner Kevin Young, author of a recent report into real estate lending. It's really important for developers to be able to demonstrate to prospective lenders a successful track record and strategy for delivering and de-risking projects. But the weak market means many developers are not even able to sell enough off-the-plan apartments to get funding for their projects. Market conditions have made it hard to overcome hurdles such as pre-sale requirements to meet debt cover and unlock funding, a non-bank lender, MaxCap, said earlier this month. There's definitely enough liquidity in the system, MaxCap Chief Investment Officer Bree Sokolowski said. The challenge is getting to meeting the conditions presented of the funding. So there we have it, everyone. Let me have a shot of coffee before we have a bit of a talk about it. So we have Commonwealth Bank taking a huge hit in their apartment loan book, everyone. A huge hit in their apartment loan book. So down from 36% just after the peak, to only 18%. Its total loan book for residential has dropped as well. So look at that. Nearly $3 billion less. $3 billion less. And we've seen, have a look at the climb in property prices. Just since 2017. It's cooled off a bit since then, but we're not quite at that level again. Right now we've got problems with business confidence and conditions are down. You've got consumer confidence and conditions are down. You've got migration, which is non-existent, and our tourism sector is also gone. So, and then this all comes back to our favorite industry, construction. Look at those dwelling unit approvals just tank for, houses and for non-houses. It's showing you, the developers can't get the money, but there's not as much demand for the developments. Property spruikers are saying, but property will go up because there's the pipeline's shrinking. Sure, the pipeline's shrinking of future work, but so is the potential demand for future work. It's essentially been cut off. And then we're going to see, once these developers struggle to get work, you're going to see more and more, or struggle to get funding, you're going to see more and more people in the construction game that are dependent on the developer turnover, developer projects, start to pull back, start to reduce their workforce. How many of these businesses are just running on fumes from JobKeeper? I hope not many. I know of other architects that were completely dependent on this multi-res sector. And, it can switch off overnight. I had some, let's just say, unpleasant experiences working for developer clients in the past, so I don't really tend to chase that work. I find they're quite demanding in their requirements, and what they compensate you to, it just isn't worth the pain. To be honest. And when you see how much they make on these things, it really is putting the knife in. So what do you all think, everyone? What do you think? We'll have a look here. Let's bring up a few other charts. This is one I really like to show. The red rooster line and the goat cheese line. So the posh suburbs, which are getting unit price increases, but all the western suburbs, working class suburbs, invest the stock, you're not making any money. How many people are buying into these things thinking they're going to make, a fortune, or retiring, or negative gearing one after the other. And you see there's no growth. And pinning their hopes on a pipeline shrinking, pushing up the value of their properties. But we're starting to see, and we looked at that yesterday, the beginnings of forced sales. We've got JobKeeper going on. You've got the mortgage holidays, which have been extended until March. You've got trading while insolvent, which should, the lack of liability while trading while insolvent, that should disappear next month, and we'll have to see what happens. So all of these things coming together, CommBank removing reducing their exposure. What do you all think, everyone? Let me know your thoughts and opinions. Do you think this will manifest in the property sector? How do you think it'll hit construction? Are you in the game? Are you in construction? Are you working multi-res? Are you noticing it? Let us know in the comments. Thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day. I will see you all in the next episode. Bye for now.